Welcome back to Watch Your Assets, where we've got your money on our minds. I'm your host, Stephanie Bracken, and today we are going to be talking about long-term care. Now, this isn't the most exciting topic in the world, and it's honestly one of the more not talked about topics because nobody wants to think about their own mortality. Nobody wants to think about the possibility of having chronic health problems and having to stay in a facility that isn't their own home, being cared for by someone else, not being able to take care of themselves. But unfortunately, that is a lot of the reality for a lot of people in America. I think sometimes we think that as we get older, first of all, we think that's not going to happen to us. We don't want to, we don't want to think about our own mortality. We don't want to think, we think we're healthy today, so that means in the future we're not going to have health problems. But the reality is, there isn't going to necessarily be some sort of catastrophic event that happens to you and then you decline rapidly and then you pass away a couple months later. The reality is most people are going to decline slowly over time, experiencing health problems along the way, and have to potentially get some extra help from someone else, meaning a skilled nursing provider, someone who comes into your home and takes care of you, a nurse, having a night nurse, something like that. Or maybe you end up living full time in a facility because you can't go up your stairs anymore. Your home isn't, a lot of homes in America are not wheelchair/handicap accessible. You have to get some modifications done to your home. And if you don't have the resources to do that, it might just be easier to move into a long-term care facility. Maybe you have a lot of your children, as you get older, are moving away from home and now they have their own families to take care of. So you don't want to be a burden on them anymore, and they can't fly in from California to Pennsylvania to come and take care of you every day. So there's a lot of different facets that are going to go into long-term care, but I want to provide you all with some statistics about long-term care just to further compound this point that there's a really good chance that you're going to need some kind of long-term care at some point in your life. 70% of people over the age of 65 are going to need some form of long-term care. That's 7 out of 10 people. So that is a huge percentage of our population. And of the, there's about 3.9 million people in skilled nursing facilities today, and about 78% of those people stay for at least 100 days. So that is a long time that you're going to be assuming someone's going to take care of you, and probably assuming the costs of that facility. You have to pay those people to take care of you. They're not working for free, and you would expect that. You're having someone care for you full time, helping you get up, move around, eat, feed yourself, going to the restroom, all of these things. If you need someone to take care of you full time, you would expect those people to get paid to take care of you. And then just further breaking this down in terms of the ages of the residents, 16.9% of the people that are in nursing facilities are younger than 65. 46.7% of them are between 65 and 84, so that's the good majority of it. And then 36.4% of people are age 85 and older. And breaking it down by gender, I think this is a really staggering statistic. 67% of the residents in nursing homes are female, and only 33% of them are male. And I think I've talked about this in another episode. Men don't always live as long as women do. We have a longer life expectancy than men do. Women we tend to be natural caretakers as well. So as if your husband's health declines a little bit faster than yours does, there's a good chance you're going to take care of him, or you're going to be able to take care of him, and he may not need to go into a facility because you're able to take care of him. On the flip side, there's a really high percentage, this is a very unfortunate statistic, but if women get sick, there's a really high percentage of men that will divorce their wives if they have cancer, if they have some kind of long-term illness. I don't know exactly what the statistics are, but it's a really high percentage of men will leave or divorce their wives, cheat on their wives, whatever it is, because of a long-term care or a health event for their partner. And so that's a really unfortunate circumstance that women have to take extra care to plan for. And again, I want to make sure, and not only that, but again, because women live longer, they're probably going to stay longer in a nursing home than a man would in the event that both of you might need to be in a long-term care facility. So there's a lot of things to think about when it comes to long-term care. And I hope that doesn't scare you, because there are measures you can take to protect yourselves against this event of long-term care, but it's going to be potentially something to plan for. And I don't want to, when we're reviewing financial plans with people, this is one of the things that we're going to build in, especially for that 55 to 65-year-old crowd, because that's about the age whenever long-term care insurance might start to be part of the conversation. There's another statistic that 38% of people age 65 to 69 were denied long-term care coverage, this is a 2021 statistic, because of health problems they were already experiencing. So there are going to be, whenever you go to apply for long-term care insurance, they're going to do a lot of investigating about your health history. They're going to want to do blood work. They're going to want to do a physical for you. They're going to want to get some records from your health or from your health insurance from your providers to see what your health history is like, because the insurance company is assuming some of the risk that you're going to need to use that benefit from them. So they want to make sure that they can protect themselves a little bit. They want to reduce their own risk of having to insure people who are definitely going to need the long-term care benefits. And that goes for any insurance coverages too. With life insurance, the insurance company is almost betting against you that you're going to outlive the term of the policy if it's a term insurance policy. If you have whole life, they're going to increase your premiums because they know that they are going to have to pay out a death benefit to your beneficiaries, because you're assuming that you're going to keep that policy in force for your entire life. So the insurance company is trying to work against the person who's being insured. They want to see healthy people getting long-term care insurance. That's going to potentially decrease your premiums as well. So that age 55 to 65, when you're going to do and go through that underwriting process, that's going to be that sweet spot for being able probably to qualify for a pretty good benefit with pretty reasonable premiums. And there's a couple different ways those premiums can be structured. You can either pay one lump sum up front for your long-term care coverage. You can pay over the span of 10, 15, 20 years, something like that, or you can continue to pay for your entire life. Most people do the 10 pay just because that's a nice, again, sweet spot where your premiums aren't going to be super outrageous. And then you can, if you got it at 55, after age 65, you don't have any more premiums, so you don't have to incur any further costs. And then there's something else with long-term care insurance that is usually put on the policies. It's called an elimination period. So these are either 30, 60, 90 days, something like that. It's going to depend on the insurance coverage that you get. But what that means is if it's a 90-day elimination period, if you go into the nursing facility on January 1st, your 90-day elimination period means that from January 1st until March, you're going to have 90 days when the policy is not going to pay any benefit to you. After 90 days is when they will start paying out the benefit. But in those 90 days, you're going to need some long-term care costs built into your portfolio, an extra reserve of money ready to go for those costs before the insurance company will start to pay those benefits. And the elimination period is another one of those gambles that the insurance company is taking, because they want to assume that you're not going to outlive the elimination period. So they are assuming that you will pass away. If your elimination period is 90 days, they're assuming you're going to pass away within 30 to 60 days. So they don't have to pay out any benefits to you. So there's a lot that goes into it. But again, if 78% of the people in nursing facilities stay for at least 100 days, you're going to at least get 1 month of benefit out of that policy should you put it into place. But really what long-term care insurance is going to do is it's going to be some portfolio insurance. And I want to talk a little bit more about some numbers here, because long-term care is extremely expensive. These are 2025 numbers. National average stay for a year in a private room full-time nursing home facility, $136,948. In DC, we have a lot of clients in DC. That's a little bit higher. It's almost $200,000. It's $195,640 a year, again, for private rooms. Shared rooms, if you have a roommate, those are going to be a little bit more cost effective, but not by that much. And then in Pennsylvania, we have a lot of clients in Pennsylvania as well. That's the average there for the state is $166,685. For Virginia, it's $126,383 per year. And that's in today's dollars. So if you don't need long-term care for another 20 years, there's no way the cost of long-term care is going to go down. The cost of living is more expensive over time. Salaries for the nursing home workers is getting more and more expensive. The cost to run that facility is going to get more and more expensive. So whenever I'm running plans, we average that out to about $120,000, $130,000 a year, but we use today's dollars and we inflate that number by 4% each year. So we're using some sort of cost of living adjustment on that expense to prepare for a long-term care event, perhaps in your 80s. So by the time we get to age 85, if you're 55 now, we're looking at costs more like $500,000 for 1 year of care versus that $120,000 that it is today. So that's a really, really huge expense for someone. Probably you, but it could be your children. It could be, a long-term care policy. But if you have that elimination period and you're expected to foot the bill for, a few $100,000 of expenses before your policy is going to kick in, that's something that's going to eat into your retirement plan. So when I'm looking at your retirement plan, not only am I wanting to look at your normal cash flow in retirement of just what is your lifestyle like today and can you sustain that in retirement? Are you saving up enough to continue living a similar lifestyle to what you're living now? But also, even if you have a large pile of money at the end, if you have long-term care, that could be $2 million by the time before you pass away. If you're in the nursing home for, 4-ish years, that's a lot of portfolio assets to eat into. That's eating into your legacy. If you have legacy goals, if you want to be able to pass on a large sum to children, grandchildren, or any other family members, that's really eating into that piece of your plan. So it's not something people, again, always think about, but it's something I'm thinking about for you because I don't want to see you get into a situation where you had the assets whenever you started, but you were in a long-term care facility for 8 years. You ate through all your assets, and now Medicaid is going to come into play. With Medicaid, that's a state-funded program. They, of course, deal with older Americans, less fortunate Americans, to provide benefits for them for things like long-term care. And there are specific Medicaid facilities that aren't so nice compared to those in a private, well-established nursing facility that's privately owned. But if that's the case, then you're going to have to move into potentially a Medicaid facility that might not be as nice. You might not get the same level of care that you were getting compared to that private nursing home. So that's a really huge piece of the equation. And again, there's a couple things you can do to help mitigate that. Again, maximizing your retirement savings where possible. You're maximizing your retirement savings not only for your own retirement living expenses and just to continue, again, traveling, doing what you want to do and spending time on your hobbies, spending time with your family in retirement, but you're also shielding the event that you're going to have long-term care. You're shielding your portfolio against these giant costs with sustaining or maximizing your retirement savings. You're putting away a certain dollar amount to earmark potentially for long-term care. Or in retirement, taking on more risk than you necessarily have to because you have a history of people going into long-term care facilities. So that's a risk that you're taking on if your portfolio is naked, exposed to the markets, just because you need to get greater returns to hopefully shield yourself against the cost of long-term care. But with a long-term care policy of some kind, you're helping to ensure your portfolio, insulate your portfolio from being eaten away by these long-term care costs. The benefits of the long-term care policy probably pay out monthly. You can have a policy that either does what's called indemnity, where the benefit is paid directly to the nursing home, or you can get reimbursed, where you would pay the costs out of your own pocket, and then the insurance company reimburses you. Indemnity is usually easier. It's less of an administrative headache, but that's going to be part of the equation too. So that's one of the other features of long-term care. And then it's going to pay out a benefit monthly. What that benefit is varies greatly, and a lot of it depends on how much in premiums you're willing to pay. We just got a quote for someone that's 45 years old who is going to, that policy is going to pay out about $14,000 a month, and his premiums are actually pretty reasonable for 10 years. They're about maybe $6,000 or $7,000 for the year, but it's because he's so young that we got those quotes for him that he'll pay until he's 55, won't have to pay the premiums anymore, and then if he needs long-term care, that policy is going to pay out $14,000 to him every single month. Now, with the cost of long-term care, that's a benefit of about $180,000 a year. If long-term care is more like $500,000, that's not everything. That long-term care policy doesn't cover everything, but it covers a darn good chunk of it. So that's really going to lessen the burden on your own assets over time. There's also policies that have a hybrid, they're called hybrid policies, where not only can you pay for a long-term care benefit, because one of the issues with long-term care insurance, if it's just standard long-term care insurance, is that if you don't need it, you lost all that money. You don't get to see the benefits of that policy. So it's a use it or lose it type situation where you're paying premiums in the event that you might need long-term care, but what if you don't? Then you just paid all those premiums for nothing. So some people don't appreciate that. But there are hybrid policies that also have a death benefit on them. So they function like long-term care, but they also function like life insurance. So if you don't need the benefit for long-term care, there is a lump sum death benefit that's paid out to your beneficiaries like life insurance. Now, if you do need long-term care, the death benefit is probably going to go away. You kind of borrow almost from the death benefit to pay for your long-term care. So by the end of your stay in the nursing home, there's probably not going to be anything left for a death benefit for your beneficiaries. But that was by design because you needed the policy for long-term care. So you were able to use the policy's benefits, but your beneficiaries won't see any of that. However, your beneficiaries might see a larger pot of money for themselves from your assets because you didn't have to tap into them for your own long-term care. The other thing is people don't want to be a burden to their family. I hear that a lot is I don't want to be a burden to my family. So having this extra layer of care, of protection on you in some way can help to alleviate that as well. So where you're not having to, again, rely on your daughter that lives in California to come and take care of you, you can know that you have some kind of benefit waiting for you when you need it for someone to come in and take care of you in your home or go into a facility full time. So those are the things to think about with long-term care. It's again, not a conversation that people want to have, but it is a really crucial part of the later years of your retirement. But if we're not having the conversation now when you're 40, 50 years old, if we're thinking about it when you're 70, it's a little too late for insurance anyways. And it might also be too late for your portfolio, depending on what your living expenses are and depending on what your goals are. If you don't care about legacy, if you don't care about leaving a pot of money behind and you want to live it up in retirement, maybe you spent the first 15 years of your retirement traveling and spending $50,000+ a year on traveling, on maybe doing some modifications to your home, downsizing, things like that. But you really took the time to enjoy your money, but now you've dwindled down your savings to the point where if you needed long-term care in your 70s, 80s, there isn't enough money there to support you. And again, now we're back to the Medicaid conversation. So it really comes down to what's most important to you, but I don't want to plan for people, even if they don't have legacy goals, I don't want to plan for them running their money to zero, because there is that chance that you're going to have some kind of end-of-life care, hospice, long-term care, anything like that. There's a really good chance that you're going to need some kind of care. So my job is to make sure people have at least some kind of reserve ready to go in case they have long-term care. And if they don't, then that's more money to, again, leave to a beneficiary. If you don't have any beneficiaries you want to leave it to a charity, whatever that looks like. But somebody will benefit from that, whether it's you or someone after you're gone, someone will benefit from that money. So I don't want to see people just running their assets down to zero, because you just never know what's going to happen in the future. And again, 7 out of 10 people are going to need some kind of long-term care. So this is a really, really crucial part of the bigger financial plan that sometimes is overlooked, and we don't want to leave that stone unturned. So when we're talking to you, we want to make sure we include that in a retirement plan. As we're looking to, age 55, we're getting close, we're thinking about retirement. Do we have enough for long-term care if that were to happen for one or both spouses? And it's going to just really depend on your diligence to your own savings, and really just keeping that in the back of your mind that someday I might need long-term care and I don't want to put that burden on my children. So something to think about. Food for thought, not probably something that needs to be talked about right this second, but the sooner the conversation can happen, the better, because again, you're increasing the likelihood that you'll be able to qualify for long-term care insurance, or potentially an annuity that has a long-term care rider on it, something like that, where we can get a little creative with some solutions for how we can help bridge the gap again between naked portfolio assets and Medicaid. So if you want more information about long-term care or about your financial plan in general, give us a call. We're always happy to help. The main number is 724-733-4334, and we're happy to discuss your options. I hope you enjoyed today's episode of Watch Your Assets. Please give us a like, follow us on all social media platforms. It is Watch Your Assets, and we will see you on the next one.